Welcome back to the Deep Dive. It is Tuesday, February 24th, 2026, and today we are looking at a company that is currently attempting a corporate gymnastics routine that, honestly, it would make an Olympian dizzy.
Oh, absolutely. It's a wild situation over there.
Yeah, we are talking about Keurig Dr Pepper, KDP for short. And, you might look at your kitchen counter and see this quiet, humble coffee machine, or open your fridge and grab a cold can of soda. But behind those everyday products, the corporate machinery is just grinding its gears right now.
Grinding gears is putting it lightly, I think. It's a massive, massive transition.
Right. So we've got a stack of documents on our virtual desk today. We are pulling from the Q4 2025 earnings call transcript, which actually just wrapped up, along with the press release and the slide deck they put out this morning.
Fresh off the presses.
Exactly. And the headline isn't just about how many sodas they sold this quarter. It's about a company prepping for a very expensive, very complex corporate divorce.
A divorce that actually starts with a wedding, which makes it even more complicated, right?
Yes. They are buying a company just to break up with it later. That's the part that makes my head spin. So our mission for this deep dive is to unpack these Q4 earnings, figure out how they are managing to grow their refreshment side, which is booming, while dealing with some real headaches on the coffee side, all while prepping to split into two separate public companies.
It really is a classic tale of two cities within one balance sheet. On one hand, you have the fizz and the caffeine rush of the energy drink market, which is just sprinting right now. And on the other, you have the morning brew, which is kind of trudging through some pretty thick inflation mud.
Trudging is a good word for it. But before we get into the psychology of the split, let's look at the report card. They just dropped the numbers for the fourth quarter of 2025. How did they do?
On the surface, they did quite well. I mean, they beat expectations, which is the first rule of keeping Wall Street happy.
Right. Always beat the consensus.
Exactly. So Q4 net sales hit $4.5 billion, which is up roughly 10% reported. And for the full year of 2025, they brought in $16.6 billion. That's up over 8%.
And what about the earnings per share, the EPS?
They hit 60 cents for the quarter, so they beat the consensus by a penny.
Just a penny.
Just a penny. But a penny might not sound like much to you or me. When you're trading millions of shares, though, that penny proves to investors that management has their hands firmly on the levers. The financial engine is running smoothly.
Okay, the engine is running, but they're deciding to swap out the entire chassis while driving down the highway at 80 miles an hour. Let's unpack this separation plan, because this was definitely the strategic aha moment of the whole earnings call.
It completely dominated the conversation. Analysts couldn't stop asking about it.
Because they are in the process of acquiring JDE Peet's. Now, for listeners who might not know, JDE Peet's is already a massive global coffee entity.
Yeah.
KDP owned a chunk of it, but now they are buying the rest to hit all under one roof.
Right, and they expect to close that acquisition around early April.
Okay, so they buy the whole thing, they become this mega beverage giant. And then, almost immediately, the plan is to break it back apart by late 2026. To me, that sounds like, I don't know, buying a massive house just a saw in half. Why go through the trouble?
It does sound incredibly counterintuitive when you put it like that, a merger just to separate. But you really have to look at it from an investor's perspective. Right now, KDP is a hybrid.
A hybrid of what?
Well, it's part chaotic, fast-paced energy drink marketing company and part steady, hardware-focused coffee utility.
And Wall Street generally hates hybrids, right?
Oh, they despise them. They call it the conglomerate discount. Think about it. An investor who wants high-growth, high-risk energy drink exposure, the kind of person betting on the next Red Bull, they don't necessarily want exposure to the volatility of green coffee bean prices in South America.
Yeah, want the race car. They don't want the cargo ship.
Exactly. And the coffee investor who wants steady dividends and commodity exposure, they don't want the volatility of pop culture marketing wars. By buying JDE Peet's, KDP consolidates all the coffee assets, the beans, the roasting, the Keurig machines, the international distribution into one giant, neat package.
So they're basically organizing the cupboard before they move out.
That is a perfect way to put it. Once they have this global coffee co organized as a standalone entity, they spin it off. And then what you're left with is Beverage Co., which keeps Dr Pepper, Canada Dry, and that whole booming energy portfolio.
And management explicitly said on the call that selling energy drinks to teenagers requires a vastly different playbook than selling high-tech brewers to households.
Yes. They believe these two businesses will just run faster if they aren't tied together in a three-legged race.
It's the pure play thesis.
It is. And for the coffee side specifically, it allows them to be the world's largest pure-play coffee company. That has a certain gravity to it for investors looking specifically for that steady commodity exposure.
Well, speaking of running fast, let's pivot to the side of the business that is absolutely sprinting right now, the U.S. Refreshment Beverages segment.
This is the star performer, without a doubt. If you look at that segment, sales were up nearly 12% for the full year.
That is massive for a mature industry. Usually soda sales are just flat or even declining.
Exactly. You don't usually see double-digit growth in legacy soda.
And the crown jewel, unsurprisingly, is Dr Pepper. I saw a stat in the transcript that actually blew my mind. Dr Pepper has gained market share for the 9th consecutive year.
The 9th year in a row. It's remarkable.
That is a dynasty. That is like the New England Patriots of soda.
It really is. And it's not just legacy buying either. What's impressive is how agile they are with their marketing. They aren't just resting on their laurels or assuming people will buy it because their parents bought it.
Oh, we have to talk about the TikTok thing.
The jingle?
Yes. Management explicitly mentioned this on an earnings call, which is so funny to me. There was this viral user-generated video on TikTok with a jingle that went, Dr Pepper, baby, it's good and nice.
Good and nice. Simple, effective, and weirdly catchy.
It totally lit up social media. And instead of ignoring it, or, God forbid, sending a cease and desist because of copyright infringement, KDP's marketing team grabbed it. They actually put it into a national championship TV ad spot.
That is the definition of cultural resonance. It shows they aren't just a dusty old soda company. They are listening to where the attention is and letting the users build the brand for them.
Yeah, leaning into the joke.
But while Dr Pepper is the steady, reliable linebacker, the real explosive speed is coming from their energy portfolio.
Right, this is the energy drink powerhouse they've been building over the last few years. They acquired Ghost Lifestyle recently, and it sounds like that is paying off huge.
Huge is an understatement.
Yeah.
Ghost contributed about 3.6 percentage points to their volume mix in Q4 alone. That is significant volume for a newly acquired brand. But what's really fascinating here is their overall portfolio strategy.
How so?
They aren't betting the house on just one horse. They aren't trying to make one can that rules them all.
Right. They have C4, they have Ghost, they have Black Rifle, and they have Bloom.
And that diversity is key because the energy drink consumer isn't just one monolithic person anymore.
It used to be just, teenage boys and long-haul truck drivers.
Exactly. But now, look at the breakdown they have. You have C4, which heavily targets the gym rats, the fitness performance crowd. It's all about gains and pre-workout.
And then Ghost.
Ghost hits the gamers, the lifestyle crowd, the flavor chasers. They do those crazy collaborations with candy brands.
Oh, yeah, the Sour Patch Kids flavors. And then there's Bloom. I actually see Bloom all over my social media feeds. That's the prebiotic wellness-focused angle, right?
It is, and it skews heavily female. That is a demographic that traditional energy drinks like Monster or Red Bull have historically struggled to fully capture. And then you add Black Rifle coffee to the mix, which hits a very specific, patriotic, outdoor lifestyle demographic.
It's almost like they're trying to cover every single tribe in America.
That is exactly the strategy. Instead of trying to make one drink that appeals to everyone and ending up with something boring that nobody loves, they have a specific brand for every specific tribe. Energy is a $28 billion category right now, and it's growing in the teens.
So if you don't have a product for the gamer and the gym goer and the wellness enthusiast, you are just leaving money on the table.
Exactly. KDP is making sure they have a can in every single hand.
They also mentioned some flavor innovation to keep the hype train moving. They are bringing back creamy coconut Dr Pepper in Q2 of 2026.
Limited time offers are brilliant. They drive hype, they create a sense of urgency, and they get premium shelf space. They also mentioned extending Canada Dry Fruit Splash to a strawberry flavor.
Okay, so the cold fizzy side of the business is clearly having a party. But let's walk over to the other side of the room, the coffee side. It feels a little more somber over there.
Somber might be the perfect word. U.S. coffee had a noticeably softer quarter. Revenue was up slightly, about 4%, but if you look under the hood, that was entirely due to price hikes.
Not volume.
Right. The actual volume, the amount of coffee pods and brewers they sold was down.
So people are paying more, but they are buying less stuff. That is never a great trend line for a consumer business.
It's really not, and they are facing some serious macro headwinds right now. The biggest one is inflation. Green coffee prices and tariffs are hitting them very hard.
I want to focus on this for a second because the CEO, Tim Cofer, spent quite a bit of time explaining this concept of a lag effect. I think this is crucial for listeners to grasp. We've been hearing about high coffee prices in the news for a while now. Why is management saying the pain is going to be worst in Q1 of 2026? Why not 6 months ago?
It all comes down to how massive corporations buy commodities. They don't just drive down to the market and buy beans at today's price. They use hedging contracts.
Right.
Basically, they agree to buy coffee months or even a year in advance at a set price.
So it's like locking in your mortgage rate.
That is the perfect analogy. For most of 2025, KDP was brewing coffee using beans they essentially bought on paper back in 2024. When global prices were much lower, they were protected by that low fixed rate. But those contracts eventually run out.
And now the bill is coming due.
The bill is coming due. The low-rate mortgage expired, and now they have to refinance at 2026 rates, which are significantly higher. Those high-priced coffee contracts they signed recently are finally flowing through to the profit and loss statement right now in the first quarter of 2026.
So that creates this temporary squeeze where their costs skyrocket, but they can't necessarily raise prices on the consumer fast enough to match it without totally killing demand.
Precisely. That is exactly why they issued a warning for Q1 2026 on the call. They explicitly told investors this quarter is going to look messy.
But they also said not to panic, right?
Correct. Because as those high costs cycle through the system and as their new higher shelf pricing takes full effect, the margins should recover in the second half of the year. It's a timing mismatch.
But they can't just price hike their way out of this long term.
Yeah.
Eventually, the consumer just says, forget it, I'll drink instant or I'll go to the local drive-thru.
Or more likely, I'll go to Starbucks or I'll buy an espresso machine.
Yep.
KDP knows this. They realized that for a long time, the word Keurig just meant convenience. It was the good enough cup of coffee you drank because you're in a rush to get to work.
It was utilitarian. It got the caffeine into your bloodstream.
But the market has shifted dramatically. Consumers, especially younger ones, want premium. They want espresso. They want cream on top. They want cold brew. If Keurig stays entirely in the cheap plastic cup lane, they die a slow death.
Enter the Keurig Alta. This was teased heavily in the slide deck.
The Alta is their big strategic bet for late 2026. This isn't just a plastic machine that pokes a hole in a foil lid. It's an entirely new brewer platform designed specifically to do high-pressure espresso-based drinks.
So they are finally coming for the Nespresso market.
They absolutely have to. And they are pairing it with something they are calling the Keurig Coffee Collective. For the first time, they are trying to make Keurig a coffee brand itself. Actual premium pods, not just the plastic hardware technology.
And I saw they're also partnering with La Colombe for cold brew draft lattes.
That is a critical move. Think about the morning ritual. For Gen Z and millennials, coffee is increasingly cold. Even in the dead of winter, people are walking around in parkas holding iced coffees.
It's so true.
If Keurig is only known as a hot coffee machine, they lose that entire demographic as they age up. The partnership with La Colombe is the way of saying, we can do cold, and we can do it at coffee shop quality, right on your counter.
It's really a survival play. They have to prove that the pod format can be premium.
Otherwise, the global coffee company, once it actually spins off into its own stock, is just a legacy business in a declining market. They are betting the farm that Alta can change the consumer perception.
So on one hand, you have the refreshment sprint, and on the other, you have this coffee marathon where they are trudging through inflation mud. Let's talk about the actual money mechanics for 2026. What is the guidance they gave Wall Street?
Despite all the noise and the Q1 warning, the full-year guidance is solid. They are targeting low double-digit EPS growth for 2026. And for the standalone KDP business, so just the soda and energy side, they expect net sales to grow 4 to 6%.
That seems pretty healthy for beverage.
It is healthy. And importantly, they are projecting about $2 billion in free cash flow for that standalone business.
Yeah.
And they desperately need that cash.
Because they use the corporate credit card to buy JDE Peets.
Exactly. They are taking on significant debt to make this massive acquisition happen before the split.
Yeah.
Deleveraging, paying down that debt rapidly is going to be a huge priority.
They announced a pretty complex financing structure too, right?
Very complex. It involves $4.5 billion in preferred equity and setting up a joint venture for pod manufacturing that brings in another $4 billion.
It sounds like they're moving money around every possible way to make the balance sheet work.
It is financial engineering at its absolute finest. But the goal is clear. They want to set up both companies so they aren't drowning in debt the day they ring the opening bell on the stock exchange as independent entities.
Let's touch on the people actually running this whole process. There's a real changing of the guard happening at the very top.
There is. Tim Cofer is firmly in the CEO seat now, steering the ship. But the big news is Bob Gamgort.
The architect.
He really was. Bob Gamgort was the one who put Keurig and Dr Pepper together in the first place back in 2018. And now he is stepping down from the board.
That feels incredibly significant. It's like the founder leaving the building just as the company splits.
It officially signals the transition from the merger era, putting these disparate things together, to the separation era, pulling them apart. Pam Patsley is taking over as board chair, and they have a new CFO, Anthony DiSilvestro, who joined late last year and is fully in the seat now.
So you've got a new crew for an entirely new mission. Now, I want to zoom out a bit. During the Q&A portion of the call, an analyst asked about something that affects millions of Americans: SNAP benefits or food stamps.
This was a really important moment in the call because it touches on the broader macroeconomy. There have been recent changes in eligibility for SNAP in large states like Texas and Florida.
Right, and the concern from the analyst was, if people have less government assistance for groceries, do they stop buying soda? It's a fair question, since soda is technically discretionary. You don't need it to survive.
You don't. But management's take on consumer behavior was fascinating. They essentially said, no, they don't stop buying it. They view carbonated soft drinks as a true staple. They pointed out it's actually a top 5 grocery item for households.
They used the phrase left pocket versus right pocket, didn't they?
They did, meaning even if the government benefit money shifts or shrinks, consumers will just shift their own cash from their left pocket to their right pocket to make sure they can keep buying Dr. Pepper. It speaks to the resilience of the consumer.
That word resilient came up a lot. Even with price hikes, especially in coffee, people are still buying.
They are. They might shift how they buy. Maybe they wait for a value pack at Costco, or they hold out for a grocery store promotion, but they aren't dropping the category entirely. The elasticity is manageable.
People will cut back on big-ticket items like electronics or a vacation way before they give up their daily caffeine or their afternoon sugar rush.
Exactly. It's an affordable luxury.
So let's bring this all together. If we synthesize this deep dive into the sources, we're looking at a company running 2 very different races at the exact same time.
That is the perfect way to visualize it. Race 1 is the refreshment sprint. It's fueled by viral marketing, cult status for Dr. Pepper, and this explosive ghost energy acquisition. It's fast, it's young, it's growing, and it's capturing new tribes of consumers.
And race 2 is the coffee marathon.
Right. It's facing real obstacles. Inflation, changing consumer habits, cost lags. They are trying to upgrade their running shoes with the Ultra Brewer and Draft Cold Brew, but they are running uphill against a stiff headwind.
A split later this year is basically the company admitting, look, we can't run these 2 races with the same pair of legs.
That is the bottom line. Selling caffeine cold and carbonated simply requires a different playbook than selling it hot and brewed. The split allows Beverage Co. to be the aggressive, culture-focused marketer, and Global Coffee Co. to focus entirely on the supply chain, the machine technology, and the premium at-home experience.
It's going to be a wild year to watch them execute this. You know, I was thinking about a provocative thought to leave our listeners with today as we wrap up.
Oh, what's on your mind?
Well, looking at the absolute explosion of energy drinks, Ghost, C4, Bloom, all of it, and then looking at the struggle of the traditional hot brewer. Are we seeing a permanent generational shift in the morning ritual?
Wow, that is the billion-dollar question right there.
Because for decades, the morning ritual was the mug, the smell of brewing coffee in the kitchen. But if you look at the growth rates of these performance energy drinks, is the future of the morning ritual moving permanently away from the mug and toward the aluminum can?
It's a profound shift if it's true. And if that is happening, what does that mean for the standalone global coffee company once it's out on its own? Can hardware innovation like the Ulta actually save the mug, or is the sheer convenience of the crack and sip just too powerful to beat?
Definitely something to mull over while you have your caffeine of choice tomorrow morning, whether that comes from a high-tech pod or a cold can. That is it for our deep dive into Keurig Dr Pepper. Thanks for listening, and we'll catch you next time.
Thanks, everyone.